and welcome to the Wisconsin Coalition of Annuitants virtual conference. For those of us who have not been personally affected by COVID, this has been a unique coming back to some sort of normal lives, especially for public employees trying to teach and work remotely and still trying to maintain public health, safety, and welfare of the citizens of Wisconsin. I am Diane Wolsinski, the current chair of the WCOA board. The Wisconsin Coalition of Annuitants consists of statewide and regional organizations representing retirees in the Wisconsin retirement system and may include active as well as retired participants in the system. The coalition exists to represent all of the approximate 233,804 Wisconsin retirement system retirees of the more than 663,000 system participants. Each member organization designates representatives to attend monthly meetings of the coalition, where guests from the State Investment Board, employee trust funds, legislative leaders, and members of boards and commissions provide input to active discussions on retirement issues. I would like to thank our guest speakers in advance for participating in this event. I would also like to thank our annual meeting committee members, who consist of Bob Schaefer, Sandy Drew, Sandy Haas, Roger Springman, Jeannie Stengel, and especially our webmaster, Rick Wojak, for their exceptional efforts in making this happen. So as part of this virtual meeting, you will be able to ask questions by pressing the Q&A button that can be found on your screen. Just click on the symbol and type in your question. Bob Schaefer will be the moderator and will collect the questions and present them to the speakers on your behalf. Speakers will respond to the questions at the end of the presentation. Please do not use the chat button. At the end of the session today and next week, if you attend, please complete the survey as you leave the conference. Thank you very much for your participation. So our first speaker today is Mr. Edwin Denson. Mr. Denson is currently the Executive Director, Chief Investment Officer of SWIB. His appointment was made in April of 2021 after he joined SWIB as Managing Director, Asset and Risk Allocation in 2018. Edwin holds a bachelor's degree in economics from Cornell University and a PhD in economics from Northwestern University. Mr. Denson will be assisted today by Ms. Rochelle Klaskin, Deputy Executive Director and Chief Administrative Officer of SWIB, and Todd Matina, Head Economist, Asset and Risk Allocation Chief Investment Officer. Welcome, Mr. Denson.
Great, thank you very much. I hope everyone can see and hear me okay. Again, welcome. It's a privilege and an honor to be able to present to you all and give you an update on SWIB. And again, I am Edwin Denson, and with me today are Rochelle and Todd. And unfortunately, Rochelle is a little under the weather and has lost her voice. So, but she is still on the call. She'll be running the slides for us. And so you'll only be hearing from myself and from Todd. So if we could kick it off, please. Agenda, I will be addressing performance of the core and variable trust funds. Also talk a bit about costs and how we manage that and our cost effectiveness. Then give a little bit on our current asset allocation, so our exposure that we have in the core trust fund to various asset classes. And then I will be turning it over to Todd to give an economic outlook. And finally, end with some news about SWIB. And then, of course, at the end, have time for questions, the Q&A. So first, to talk about performance, we at the investment board are focused on the longer run in terms of returns. The core trust and variable trust funds, the retirement system, is a very long-lived entity. And so our job is to, over the long run, deliver the returns that are necessary to keep the system as a whole very healthy. And to demonstrate the value that we've been able to add over the last 20 years as an investment board, we have the following exhibit that you see on the screen. So if you look on the left, that chart demonstrates over the last 20 years what $100 invested would have looked like in terms of the cumulative return over, again, the last 20 years. The bottom blue line that you see represents that $100 invested in a very simple, low-cost alternative to the investment board, and that would be a portfolio that has 60% in passive global equity and 40% of the assets in a passive U.S. fixed income, and again demonstrates how that $100 would have accumulated over the last 20 years. The second line on the chart, the yellow line, that's what you would have experienced if we had invested that same $100 in our policy, so our asset allocation policy, and that demonstrates the value added that we benefit from in terms of being exposed to a much wider range and more diversified set of asset classes than that simple 60-40. So for example, on the equity side, in addition to global large cap equities, we also have exposure to emerging market equities in the large cap space. And then also we have more diversification in terms of the capitalization spectrum that we are exposed to. So that stock allocation includes mid-cap stocks across the board and also small cap stocks around the world. Same thing with the fixed income exposure. Rather than simply being exposed to U.S. Treasuries and investment grade corporate bonds, we also have exposure to high yield bonds, to emerging market debt, and to leveraged loans. And also very importantly, the exposures include other asset classes like private equity and real estate. And again, that yellow line represents the benefit that we get from being able to have exposures and investments in a much more wide-ranging set of asset classes than the simple 60-40. Finally, the top line is the actual performance of the core trust fund, and the difference between that line and the yellow line represents the benefit that we get from the investment selection and security selection activities of both our internal portfolio managers and our external partners that we use to help us with that exposure that we have to some of the other asset classes. On the right is a table that demonstrates the benefit in percent terms and in dollar terms. And the bottom line is, if we move over to the furthest right column, we see that the benefit from our asset allocation or our CTF policy benchmark versus that simple 60-40 alternative has led to almost 23 billion in additional value added over the last 20 years. And then the next row down is the additional benefit that we receive from that investment and security selection activity that we engage in both internally and that our external partners help us with. And that leads to a sum total of over $34 billion in extra value added over the last 20 years for the retirement system. Again, we focus on long-term performance. And so here we see how well that the core trust fund has done over the 5-year, 10-year, and 20-year timeframes. And we see that in the longer timeframes, the 10-year and the 20-year timeframes, our return has been above that which is required to keep the plan healthy over the long run. In addition to that fact, we also have outperformed the policy benchmark over those horizons. And then moving to the left, on the most recent 5-year horizon, again, we have performed better than the underlying policy benchmark, but have fallen a bit short of the actuarial rate. And that was due to the very adverse outturn that we saw last year in terms of the performance of every major public asset class around the world. And then finally, if we go to the bottom, we see that year to date, as of the end of February, in terms of official final performance, we were up 2.22% for the year through the end of April. and again, beating our policy benchmark by a moderate amount. And I can just tell you that on a preliminary basis, as of the end of the first quarter, so as of the end of March, our total return was about a little over 4% for the year for the core trust fund. Now, putting that the return in context, if we look shorter term, as I referenced on the previous slide, last year was a very rough year for returns in the public markets. Not only did more risky assets like equity and the riskier parts of the fixed income market like high yield do poorly, but in addition, we had a very rare event happen, and that is in the context of those assets falling significantly. Government bonds sold off as well. And so here we see as a representation of that, that the S&P declined over 18% in 2022. Government bonds and high and investment grade credit fell double digits as well, over 13.5%. But again, in the context of that, we lost 12.92%. Again, that's the benefit of having the more well-diversified set of exposures in terms of asset classes. And then in addition, as you see, our policy benchmark declined 13.29%. So even though it was not a good year for the absolute return of the core trust fund, we did continue to beat our policy benchmark in terms of the investment activity, again, of both our internal portfolio managers and our external partners. Looking at the variable fund, again, this is the smaller of the two funds and represents about 7% of WRS assets. It is a stock-only fund, and so therefore it had a more adverse outturn than the core trust fund because you don't have the diversification of other asset classes in it, and we lost almost 18% in 2022. Again, a very tough year for equity markets around the world. Did beat the benchmark though by a little bit. So again, positive outturn for the investment activity of the portfolio managers. And then you can see there on a longer term basis, 5, 10, and 20-year basis, the variable trust fund has done well in absolute terms and done moderately well versus policy benchmark. And again, year to date, if we're looking shorter term, it was up about 4.6% through February, and on a very preliminary basis, it's up about actually 7% year to date through the end of the first quarter. Now I want to turn to looking at costs. So again, in addition to looking at returns, which we have seen, and those are net returns, so that does take into account the costs, but we do want to break out and look at costs because we do look to optimize these through time. And the idea being that every dollar that we can save is a dollar that the WRS has retained and that we can invest and grow over time. We do not necessarily look to be the lowest cost, but we do want to spend effectively and invest in people and technology that can help us to generate returns. We do have to spend some money in order to make money. Slide 9 gives context for how well we are doing in terms of our costs. We hire an independent cost consultant called CEM. They are based in Toronto, up in Canada, and they analyze our costs. And they've been doing this work for us for more than a decade. So they're very familiar with our structure and how we're set up, and can do a very good job, again, of breaking out and assessing our costs as an independent entity. They collect cost information from about 49 US funds, and then also many more pensions that look like ours in Canada and around the world. And we are compared two ways in this exhibit. The first comparison, which is up top, the bars, is a comparison to a peer group of the 15 largest US funds out of the 49 that they collect information from. And just as a note, the costs are reported on a 1-year lag. So these costs represent the comparison to peers for the calendar year 2021. And what you can see here is that our costs are about 4.2 basis points below the peer median when you strip out hedge fund performance fees. And that 4.2 basis points translates approximately to $54 million of savings, again, for calendar 2021 versus sort of the peer median. Now, as a note, the total bar, or the total height of the bar that you see there, which includes both the dark portion and the light blue portion, that light blue portion, there are hedge fund performance fees. And these are the fees that we pay hedge funds when they exceed a certain threshold of performance. So we only pay them when they do well for us. So paying more in these fees actually means that we have had more net revenue from those investments. And since this slide is only about cost, it doesn't really provide that context that on the other side of that additional cost, there was a net benefit that a significant net benefit that we've received. So paying performance fees is generally good because, again, that means that there was good performance that we experienced that we needed to pay for. Now, in addition to this comparison to 15 large US funds, CEM also provides a comparison of us to the entire group of all 49 US-based pension funds that they collect information for. And here our costs were 7 basis points lower than the peer median, which translates to $91 million in savings, again, for calendar 2021. So again, I want to emphasize that we look to be cost effective, but again, we're not looking to minimize costs. We're just looking to be optimal and effective in how we spend, because again, you do have to spend money on people, on resources, on technology, et cetera, in order to be able to deliver outperformance. The next exhibit here demonstrates the relative cost effectiveness to running strategies internally versus externally. We do have to note, however, that it is not always possible to run an investment strategy in-house. We have to be careful to make sure that we have the right investment talent and that the markets that we're investing in are ones that we don't have to actually have the feet on the ground and be there in order to benefit. And those are typically some areas on the private side, and that we also need to have the right systems and technology and investment platform in place in-house in order to be able to execute. You can see on the slide that for these in-house strategies that we can run, we can be much more cost effective than if we engage an external partner. But again, however, we're always going to have to rely on outside partners who generate the necessary returns at costs that are also reasonable, given the markets that they are able to give us access to that we really can't effectively access ourselves. And then finally, slide 11 demonstrates the cumulative savings over the last 10 years that we've been able to generate compared to that group of the 15 largest funds, and that has accumulated to $903 million over the last 10 years as a function of our discipline on costs. Now, some words about the asset allocation. And here you see on the pie chart our asset allocation targets for the current calendar year. Again, you can see the diversification of exposures that we have relative to a simple low-cost alternative. We do have public equity, and again, there's more breadth in that private public equity exposure than in a simple passive implementation. We also have a very richly diverse exposure to public fixed income. We have an inflation sensitive bucket, as we call it, of 19%, and that comprises TIPS, so it's Treasury inflation protected securities. We also have an 8% allocation to real estate, and then a 15% allocation to private equity debt, and that's also where our venture capital investments reside. And with this asset allocation, if we look to the table to the right, we can see what we expect to get from just the asset allocation. Over the next 10 years, we would expect that to return us 6.7%. Over a 30-year time frame, a little over 7%. And with a standard deviation, that is a fancy word for how risky or volatile that return or that asset allocation can be. And then the Sharpe ratio is a measure of the efficiency of the portfolio. And then finally, at the bottom, you see there's a target active risk. And what that means is what risks we want to take in terms of that, again, that individual security selection and investment selection. If you can think back to the chart that we had demonstrating cumulative returns over the 20-year time frame, this target active risk represents the risk that we need to take to move that yellow line in that chart up to the dark blue line, our actual investment portfolio. And with that, first, I'm going to want to introduce Todd and then turn it over to him to give you all an economic update. So Todd joined us recently in January of 2023. He's responsible for taking the broad economic conditions in developing and recommending and implementing our asset allocation in light of those conditions and market expectations, and also in charge of other policies that we have in terms of allocating investments. He supports our investment decisions and determines how to best leverage policy to address the opportunity, risks, and challenges that we see in the market. And again, he'll explain some of those in his part of the presentation. He's got more than 20 years of experience in doing economic analysis and investments. It's very important to have experience in both, as I did before joining SWIB. And again, he's had just a wealth and breadth of experience. We're very happy to have him, very glad to have him. And finally, again, he has a very good pedigree in terms of having a doctorate in economics as well. And with that, I will turn it over to Todd to take us through the outlook.
All right. Thanks, Edwin. I really appreciate that kind introduction. And good morning, everyone. Really great to have this opportunity to speak with you all today. So in this part of the presentation, I'm going to outline SWIB's current economic outlook. And I'm going to do that by breaking it into two pieces. The first piece being what I'm calling the cyclical outlook, which is really the outlook for the next 12, say, to 24 months. And the second piece will be some brief thoughts on the longer term outlook, which of course is relevant to us as long-term investors. So if I start with the cyclical outlook, you can see this chart that we have on the slide on the right. And what this chart represents is the Conference Board's composite or average of leading economic indicators. And this is basically 10 variables that together have been very good at forecasting turning points in the business cycle, or basically recessions. And what you can see in this chart is that when the composite of leading economic indicators declines very sharply and persistently, it tends to be associated with recessions. And you can see the recessions in the gray shaded areas. And you can see it at 2008, 2000, 2001, early 90s, and so on. The leading indicators typically have a forecast horizon of about a half a year ahead. So what this chart is showing is that our current readings on the leading economic indicators are at levels that historically have been associated with recessions in the past. So this is, again, another indicator, another way of saying that the risk of a recession in the US has gone up significantly over the next 6 to 12 months. The other key economic variable, of course, everyone pays attention to is inflation. And inflation, not shown on this slide, a future slide will show that, but inflation has been high, as we all know, and also persistently high or sticky. So we have this mix of a weakening economic outlook, even rising risks of a recession, combined with high and sticky inflation. So it's kind of a dismal sort of cyclical outlook. The other key development, I would say, over the last several months has been the turmoil in the US banking system. We saw that begin with Silicon Valley Bank, spread to Signature Bank in New York, and then most recently First Republic. And of course, investors and depositors are putting the regional banks under a microscope to look where the next domino could potentially fall. Importantly, for the real economy, stress in the regional banking sector and small and medium banks in general can have an important spillover effect in terms of slowing loan growth into the economy, and through slower loan growth means slower spending growth. And that's coming at a time when the economy is already slowing with an increased risk of recession. So there's a number of headwinds on the cyclical sort of 12 to 24 month horizon kind of shaping up. And the bottom line is, for policymakers like the Federal Reserve, this really puts them in a position that some economists have called a trilemma, which is basically they have three objectives at the Federal Reserve, and they have one blunt tool to try to achieve these objectives. And unfortunately, that usually means that they can't achieve all their objectives at the same time. So the Federal Reserve has communicated that they want to keep interest rates high for a good part of the year at 5% or more to bring inflation back down to the 2% target. But that could have, unfortunately, a negative impact on employment and put more stress on the banking sector. The market doesn't believe the Fed. If you look at what markets have priced in, they're pricing in as much as 4 rate cuts through early 2024. So there's quite a different view between what the market believes the Fed will do and what the Fed has been telling us. Our view is that if the Fed sticks to its guns, keeping interest rates higher for longer than expected to get inflation back down to 2%, along the lines of what they've been saying, that we're likely to see a sharper economic downturn than the consensus view. And that's in line with history. Historically, when we've seen large disinflations from such high peak rates of inflation, 8-9% annual inflation last year, back down to the 2% target, historically, unfortunately, that's often led to a hard landing or a recession. So if the Fed sticks to its guns, we could see some bumpiness ahead in the macro environment. Switching to the long-term outlook, just a couple brief points. The good news is, of course, this year we've seen equity valuations recover quite significantly. If we look at U.S. large cap stocks measured through the S&P 500 index, we've seen quite a significant recovery so far year to date. Now, the good news is that's improved current valuations in the marketplace. But what historically that has meant is that richer valuations today relative to long-term fundamentals has fairly reliably predicted lower forward-looking returns over the coming decade. So good news today, but a tougher environment over the next decade. And the other key question for the long-term environment is in the fixed income world. Of course, we've all seen interest rates increase very sharply over the last year or so. So the key question is, where are rates heading after we get through this inflationary period? Will they go back down to the very low levels we saw before the pandemic? Or are we facing a new regime, a new normal, where we see interest rates staying higher for a longer period? And there's a number of reasons, good reasons to expect that rates may stay higher than what we saw before the pandemic. Why don't we go to the next slide? Thanks. So in this slide, I just want to focus on inflation for a moment. And what you're seeing in this chart on the right is the inflation measure that the Federal Reserve prefers. This is the so-called PCE measure of price inflation. This is monthly data. It's similar to the CPI price index, constructed a little differently, a little more broadly. Importantly, it's the one that the Fed favors, so this helps inform their policy decisions. And when you look at the breakdown, what you can see that in the blue line is overall inflation. And when you break it apart and look at the two components, goods price inflation and services inflations, you can see very different dynamics happening under the hood. During the pandemic, goods price inflation, which is the yellow line, surged. Of course, there was a huge shift in the composition of demand to goods, since we couldn't enjoy services during the lockdowns. There was a supply side crunch, which drove goods prices higher. At the same time, we've now seen with the reopening of the economy that goods prices are easing quite significantly. We've also had stories of excess inventories because there was overstocking in the goods sector. So a number of forces putting downward pressure on goods. But services is where the issue is. Services, which also includes rents, by the way, and shelter costs, remain high and remain sticky. And they haven't shown much indications yet in the data of coming down significantly. This is where the Federal Reserve is really focusing. A big part of the costs of producing services are wages and labor costs. And of course, as long as wage costs and employment costs continue growing at the high rates that we've seen in the last year or so, that's going to get passed through, at least so far, it's been passed through by companies into in service price inflation. So they're passing through higher wages into higher prices. So the Fed, an important part for them of achieving their 2% inflation goal is to tackle the labor market, to slow down employment growth, and that will hopefully bring down service price inflation. Why don't we transition to the next slide? And given the importance of the labor market, probably worth spending a moment here to zoom in on the labor market. What you're seeing in the chart on the right is a measure of total employment costs called the Employment Cost Index in the blue line. And this is the annual growth rate. It's a quarterly number, so we have the numbers, the latest numbers from the first quarter of this year. And what you're seeing is a breakout in employment cost growth in the last year or so. And that's been closely associated with the breakout in underlying or core inflation at the same time, for the reasons we just discussed in the previous slide. Now, for the Fed, they're trying to keep employment cost growth in a range that's consistent with 2% inflation. And I've tried to show this stylistically here with this kind of shaded zone and kind of purple. If employment costs can grow at 2% plus any increase in labor productivity, then the Fed can reasonably expect to keep inflation within its 2% target. And you can see that historically, employment cost growth and inflation kind of trended together. And then when they broke out of this zone, it's contributed to the inflation pressures we've seen today. So an important part of the inflation objective for the Fed will be to soften the labor market, bring employment cost growth back down to somewhere likely into the shaded zone. Why don't we move to the next slide? So the other piece of the cyclical outlook is the story that's happening with the regional banks and the small and medium-sized banks in the U.S., which are generally defined as banks with 250 billion in assets or smaller. Now, this chart's a little complicated, but I think it tells an interesting story. So if you look at the red line in this chart, what you're looking at is loan growth, commercial and industrial loan growth. And you can see that it's very cyclical. It tends to move up in the good times. It tends to get very negative during downturns like 2008 in the 2000 recession. So it's very correlated with the business cycle. Now, what the blue line is it's basically based on a Fed survey of lending standards by banks. So if the banks are getting easier in their credit conditions, it tends to be associated with faster loan growth. Similarly, if the banks are tightening credit conditions, tightening credit standards, that tends to be associated with slowing credit growth. And of course, this is important because slowing credit growth means slower spending growth, which means an economic slowdown. Now, if you look at the far right of the chart where we are today, I should also mention that this tightening has been advanced by a year to give you a sense of where we're heading. So it's kind of a forecast, helping us forecast where loan growth is heading. And you can see that the net tightening has sharpened quite significantly. And since this chart was made, we've had another data point just recently, and the tightening has become even tighter. So the trend continues to get tighter, as we would expect, given all the turmoil with banks today and the concern about the health of their balance sheets. So this suggests that we're heading into a period of tighter credit, again, feeding into a slower period of economic growth. This is important because Small and medium-sized banks, there's quite a number of them. And while any individual bank may not be critical to the overall U.S. credit picture, collectively, if you put them all together, they punch above their weight. They're very large percentage of total credit growth in the U.S. economy, over half. So it's very important that the trends we're seeing with tightening credit standards, especially amongst these banks, can have a very significant impact on the overall U.S. credit. Okay, and let me just conclude with a few thoughts on the long-term outlook. So the first, what you see in this picture, in this chart, is a long-term trend in between the 10-year Treasury yield and CPI inflation. You can see that both peaked in the early 1980s, and we basically had a 40-year period of declining interest rates with declining inflation. And this, by some economists, will call this the Great Moderation, in both rates and inflation. But what we've had in the last 2 years is a breakout from this long-term trend, both inflation and in rates. The last 40 years, both inflation and rates in every business cycle we had since 1980, rates, the average rate of inflation and the average treasury yield was lower than the previous business cycle. So a steady ratcheting down in each business cycle. But suddenly things have changed. And the big question for long-term investors is, has the long-term picture changed as well? So on a forward-looking basis, are we going to see these curves turn around and start to trend higher? Or is this just a blip related to the pandemic? There's a number of reasons to think, and this is currently a very active debate amongst economists, policymakers, and investors, because obviously the direction of inflation, the direction of interest rates has a very large impact on asset valuations, on debt dynamics for different countries and corporations. So this is a very fundamental and important question. Good reasons to think that interest rates won't fall back to the levels we saw before the pandemic, very low levels of long-term interest rates. Everything from new and higher sources of spending, much larger budget deficits, including here in the US, higher levels of government and household debt in many countries, especially a big surge in debt that was needed to help finance spending through the pandemic period. And that's left us in a period where there's a number of now structural reasons to think that interest rates may not fall back down to where they were before the pandemic. So this is an important trend and something we're keeping an eye on for future implications for asset pricings and valuations. So I'm going to stop there and turn it back to Edwin. Thank you.
Thank you very much, Todd. So now to a little bit of news on SWIB. So first, an update on our Board of Trustees. So the governor has appointed Barbara Nick as our board chair and Clyde Tinnen as the vice chair. In addition, the governor has appointed Jeff DeAngelis as a trustee as of June 2022. He brings with him a wealth of experience in investing in public markets and particularly in fixed income. And then finally, we're saying goodbye to trustee Dave Stein. I think you're all familiar with him or have heard of him. Dave served for 9 years as a trustee and was chair for 7 of those years. So we're going to miss him, and we thanked him very much for the service that he provided to SWIB over the years. And the governor will be appointing a replacement for Dave as trustee in the upcoming months. So we have a lot of information on our website, including our podcast series. And these are short, we think very informative episodes on different aspects of our investment strategy and how SWIB operates. So we invite you to please access the webpage at the address you see there, and maybe pick through and look through and listen to some of these if you are interested in any of the topics. And then finally, we are going to be hosting our virtual investment forum with speakers from across the country on a range of different investment and market-related topics. Always very interesting and informative. And you can register for that by going to our website. There at the bottom, if you follow that address, you will be able to get on the page to register for that. And again, we put this on in conjunction with CFA Society Madison.
Thank you, Edwin and Todd and Rochelle, for being here this morning. The information provided on the investment side is always interesting and fascinating, especially with the questions. So at this time, our next speaker is Professor J. Michael Collins. He's faculty director at the University of Wisconsin-Madison Center for Financial Security. He studies consumer decision-making in the financial marketplace, including the role of public policy in influencing credit, savings, and investment choices. His work includes the study of financial capability with a focus on low-income families. So welcome, Professor Collins.
Thank you. Thanks for having me. Thanks for all you being here today. So I'm going to talk about some of these same topics, except not from the perspective of managing the the investment assets of our collective annuities, but more from the perspective of you as annuitants and thinking about the implications of some of this work. So there'll be some overlap, hopefully, generally in agreement with what the prior speakers talked about too, but some more focus on some of the issues that you all are facing. And then I also come from a policy background. So I'm at the La Follette School of Public Affairs. I work with students at the undergraduate and graduate level on policy issues. I'm going to talk a little bit about the particularly Social Security and Medicare policy, which I know is probably keen for many of you. Our center at Wisconsin is one of the 4 Social Security retirement and disability research centers across the country. So I'm speaking on my own behalf, not on behalf of the UW or the Social Security Administration, but certainly can give some of my thoughts in these areas, and then we can have some conversations about your questions regarding some of these important policy issues. All right, so I'm going to talk a little bit about where we are. This, again, will touch on some of the issues we just talked about. And there's really only one headline, and that's inflation. Literally, that's the headline we've seen on the news for a year and a half now, and yesterday. And so, it's amusing sometimes when I talk with students at the campus here who are in their maybe 20s. They've never really experienced inflation until now. They didn't live through the 90s or the 80s, or certainly didn't see much in terms of inflation through much of their lives, because we just haven't had really experienced variation in prices very much. So this graph shows us going back to the Great Recession of 2008. Inflation was pretty flat for a lot of that period. And so for many people, this idea of a consistent period of elevated prices just hasn't been something they've experienced. We experienced, as a result, low interest rates and, price stability, lots of other things. It's also important to remember that through much of this period of the 2010s, wages were pretty flat too. People were not seeing, especially working, lower wage workers were not seeing big increases in their wages. So, the good thing is that people are seeing an increase in their wages. The bad thing is that we're all seeing an increase in prices. And so, lots of discussion about why this happened, how it happened. We all sort of point to the what happened during the pandemic with COVID. Partly it was supply chain issues. It was hard to get stuff transported around the world. There were many factories and parts of the supply chain that were just stalled because workers were not able to get to work. Meanwhile, a lot of people had a lot of demand because they were limited in the kinds of activities they could do. And so they wanted, especially home goods and those kinds of things. So we had this real spike in inflation coming out of that really short recession we saw mid-2020, and prices spiked up at the beginning of the spike of inflation. Most economists, and frankly I too, thought, well, this will just return to normal. The supply chain will be returning to normal. The stimulus effect of these payments that were provided by federal agencies and actually globally by countries across the world to consumers, those will all fade away. and prices will start to come down. And they started to, but then they started to go back up again. And so that's really when the Fed took action, started to increase the federal funds rate and tried to get inflation under control. The big question right now is it under control? And so if you saw the news yesterday, I think, half the headline said inflation is more under control and half the headline said inflation's the same. 4.9 and 5.0 are pretty close numbers to each other. So we still have relatively high inflation. The Fed's target is 2% inflation. We're well above that. So as a percentage change basis, we're starting to see the percentage change month to month be sort of flat or smaller. So perhaps that's a good signal. But this is kind of the big wild card out there. Is inflation really under control? Is the Fed in a position where they no longer have to keep changing or raising interest rates, or can they hold pat or even cut interest rates at some point? So that's kind of where we're at. That said, it's important to think about the impact of inflation on consumers. And you feel this, you've seen it in the kinds of purchases that you make every day. So Wisconsin specifically in 2021, people made more money. Wages were up about $60 a week, which is fantastic. We have not seen that kind of wage growth in the state in a very long time. However, gas in 2021 doubled in price. Milk increased 60%. So all these kinds of basics, which for anybody on a lower income, fixed income, it's a big chunk of your overall budget, because as you earn more and more, you don't consume more and more milk, for example. So these sort of basic goods or core goods are a big part of people's income. And it just takes a bite. There's basically, we have to substitute away from some things that we'd like to spend our money on, because the cost of the things we have to spend our money on keeps growing. So the Fed did take action. And so we saw the Fed raise interest rates and continually raise interest rates. And right now there's a sense that perhaps interest rates are at least the Fed's going to stay level for right now and sort of see how the data looks coming forward. But we're still seeing those increases in prices. And so, it doesn't matter if you're looking for a new roof, or if you're looking for a car, or you're thinking about changing where you live, all those kinds of things, service costs, all these things are higher than they used to be. I think from the perspective of consumers, and, we'll talk in a minute here about the sort of some of the bank failures, and you just heard a little bit about that discussion as well. It's not just that the Fed increased the federal funds rate, it's the speed at which it happened. And it's went from a relatively low, very, very low, like close to zero base, to a very high level very quickly. So it's the relative starting point being quite low, and then the speed at which interest rates rose. So you can see in this graph, that red line is the federal funds effective rate. And the arrow is where they started to change rates in, late 2021, early 2022. And that pace of change is some of the fastest interest rate increase we've ever experienced, at least in quite a long time. And so much of what we're experiencing now in terms of the banking sector, in terms of the consumer sector, is the fact that change, that turn was so quick. So for a financial institution to adapt to that steep of an increase in rates, starting at such a low rate to begin with, it has been difficult for some. And so that's partly what we've seen. I think the other important thing to pay attention to in this graph is that blue line, which is the effective mortgage interest rate. So mortgage rates, obviously vary over time. I think one of my mortgages in the 1990s was 7.5%, and that's close to about what we are today, 7.5% for some mortgages. I think right now we're seeing sort of 5.5 to 6 for some loans, depends on whether it's 30-year fixed or whatever. But interest rates are quite high. So what does that mean for the housing market? It means there's a lot of people for whom, given a particular ability to pay a monthly payment of say $2,000 a month, they just can't buy as much house as they used to. Some people are out of the housing market. They're not able to buy a home. Some who have a mortgage that they took out before interest rates went up, who have a fixed rate mortgage, are thinking this is fantastic. I have a loan. I have a 2% interest rate. I can continue to make this loan payments on this loan for the next 18 years. That's fantastic. I will live with that. However, it also means they're less likely to sell their house. because if I move, my mortgage doesn't move with me. So I'm kind of locked into this interest rate and this house. And even though maybe I'm feeling like this house is too big for me or too small for me and not the right location, I don't want to give up that 2% loan. So that's the other thing we're sort of facing in this housing market. It's kind of weird is there's not a lot of inventory. There's not a lot of, a lot of people who are willing to sell if they have a mortgage. And what we see are more and more people with cash in the market, which is skewing that market a bit. So, all of this is having some pretty profound impacts on different aspects of the consumer economy and the overall economy. And it's just something we haven't seen in a long time. So, we're sort of feeling our way around how this is going to impact various sectors and individuals in the course of the next probably 18 months or so. All right, so let me talk a little about the bank failures. I think this has been a big topic in the media. It's something I'm happy to chat more about, and I've done some work around recently. But the big three that you've probably heard of are Signature Bank, Silicon Valley Bank, oftentimes abbreviated SVB, and then First Republic Bank. Each of these banks failed, and by a failure, we basically mean that the FDIC, the Federal Deposit Insurance Corporation that regulates banks, stepped in, guaranteed the depositors. So even though the bank failed, the depositors did not lose any money. The shareholders and debt holders in these institutions did lose money. And effectively, what the FDIC does when they find an institution like this is they find another financial institution to take them over. They either carve it up and auction off pieces of the bank, or they try to get another financial institution to take it over in whole. Oftentimes this happens over the weekend. So bank fails over the weekend, and on Monday morning, they're back open again for regular business, just under new ownership. And that's really what happened with all three of these, although it was not a particularly smooth process for depositors in these cases. And we certainly saw lots of news about that. The issues for each of these institutions is quite different. So the most recent one that we heard about was First Republic. First Republic was kind of famous for having a lot of really high net worth, high income people who deposited their money with them, and they made big deposits, multi-million-dollar deposits with that bank. So that bank had access to all this capital from these wealthy people, so they could make really low rate loans. Famously, they would make mortgage loans for 30 years for 1% or 2%, really, really low interest rate loans. However, as interest rates went up, those wealthy people with large bank accounts were very willing to move their assets to another bank that had better returns. So as all that money left, the bank still was, sitting on loans paying 1%, but they had to keep raising their return, the deposit rate. So the depositors were going to get, demanding 3% return on their savings, and the bank's paying 3% there, but they're only getting 1% on these mortgages. That's upside down. They can't sustain that. So, First Republic was really that sort of mismatch of what depositors were demanding and what they were going to be able to get on their assets. And this is true for the other banks as well. So Silicon Valley, it was often that they had long-term treasury securities and other kinds of bonds that they held that had very low interest rates that weren't getting any return, much like those mortgages weren't getting much return, and depositors wanted more and more revenue. Silicon Valley had a lot of depositors that were corporations. So they were payrolls from big corporations. And, a payroll manager who's sitting on a $50 million balance is very happy to quickly move their money somewhere else to make more on their deposit return. So, in these cases, these are banks that it's not like you and I who maybe have, $10 or $15 or $20,000 in a savings account. They are sitting on millions of dollars, and they're very quick to move their money. And that's really what these banks had, is depositors that were, pretty sensitive to the changes in interest rates and pretty willing to quickly go on their phone or go on their computer and move assets to a different financial institution. And as more and more of these large accounts move, it doesn't take very many large accounts to sort of deplete the bank's deposits. Most financial institutions that regular people are involved in have thousands, if not millions, of smaller account holders, people who have not millions of dollars, but tens of thousands of dollars. And so even if a bunch of them moved, it doesn't make that much of an effect because they're not really large depositors. So that's really what we saw with these institutions, was large depositors fleeing to try to get better rates somewhere else. And, as a bank run happens, the more depositors get nervous, the more they're likely to leave, and then it sort of results in an instability in the institution. I think we're knock on wood, we're over the hump. I think on a lot of these, we haven't seen a lot of more deposit runs, at least, although certainly the shareholders of many regional banks are getting nervous. But in terms of depositors, we haven't seen a lot of nervousness, and so far, no depositor has lost any money. But what we are seeing are, and you're probably experiencing this too, as you look at your own portfolios, is people moving money to try to find the highest interest rate they can on savings. And so that means moving oftentimes from savings accounts to CDs or time deposits, or even into fixed annuities or money market accounts or other kinds of accounts that have higher returns. Some of those have some guaranteed principal balance. Some of those are not insured by things like the FDIC. So a little bit more risk taking in some cases, but certainly people are out there trying to find the best interest rates they can. I would just say from a consumer perspective that searching around to try to find a little bit better rate is costly. It takes your time, it takes your energy, it takes your stress. You have to manage it. And you could be undermining the sort of stability of the financial institution. So if you're really invested in your local community bank or your local credit union, pulling money out of that to chase a little bit, maybe another $70 of return, may not sort of be in parallel with what your values are about your community commitment and other kinds of things. So there's lots of issues to weigh, and certainly the advent of technology like mobile phones has made moving money around a lot easier. But it's also something I think as consumers, we have to really think about, how much time and energy is it worth it? And is it sort of aligned with, do I want to keep my money, quote unquote, local? If I'm active in my farmer's market and I'm active in like other things, do I really want to chase the best return I can with some, fintech that might be based maybe even in a different country? All right, so let's turn back now to the sort of broader issues of where things are headed. And again, you heard a little bit about the sort of economic outlook earlier. I think one of the most important things to focus on is the jobs market. By and large, employees have been able to ask for more wages, getting a little bit more money in their wages and their salaries, and we haven't seen any kind of increase in unemployment. We saw a huge spike, a record spike in unemployment at the beginning of the pandemic, and it just really quickly returned to more normal and even below normal right now unemployment rates. And so I think a big question is whether we're going to be able to see a taming of the inflation rate without an increase in unemployment. And that's, I think, to be seen. We don't quite know yet. The reason that you might care about this, and particularly if you're retired or not, not engaged in the labor market, is that the unemployment rate is a really important signal of where things are headed, of consumption, of loan repayment, of a lot of the other factors that we think about. So unemployment rate is going to be something really careful that we should watch carefully. But so far, we haven't seen any weakness in the jobs market. We haven't seen any raise in unemployment. My guess is we'll start to see more unemployment over the next 6 months to a year, particularly as these higher interest rates start to bite things like the construction industry and service industry. But so far, we have not seen much of that. So why I raise that is because what we do care a lot about, especially if you think about back to the 2008 Great Recession. In 2008, people were not able to make their payments on debt. And so we saw, foreclosures, we saw repossession of automobiles, we saw credit card delinquencies, we saw lots of instability in the credit market. And so far, we're not seeing that. So this is a survey from the Federal Reserve Bank of New York, where they ask individual consumers about their assessment of their ability to make the minimum debt payment on things like credit cards over the next 3 months. We saw a little spike during the pandemic in March and April of 2020, rightfully so. Many people weren't able to work and concerned about their ability to keep up with bills. But pretty quickly that went back down and has stayed relatively low. Historic levels, generally are in this sort of about 1 in 10 people saying that they're worried about being able to keep up with their debt repayments. And so that's about where we are now. So far, so good. We're not seeing a lot of concerns right now. We haven't seen a rise in delinquencies on credit cards or auto loans, or certainly on mortgages. There's a little bit of signs of weakness in like subprime credit cards, people who have pretty poor credit records, but nothing that is at the alarming level yet. So far, consumers seem to be doing okay in terms of debt repayment. And of course, the other big thing we're paying attention to is the equity markets. So you heard a little bit about that, where where bonds particularly, or I'm sorry, stocks particularly are, but also housing values, real estate values, since, for most consumers, most households in the US today, their what net wealth is tied up in two things: their home. So it gives them a roof, but it also gives them an appreciating asset generally. And then their portfolio, whatever that might be, their retirement assets, their and the case of annuitants and the plans here, the collective assets that are producing the pension, pension payments. But I think it's all relative, right? So we saw a very long period in the 2010s of really slow growth. House prices, really went down for most markets in late 2000s. And then very slowly came back in the 2010s. Pretty similar if we look at the S&P 500 index, it's pretty slow growth through most of the 2000s. We really didn't see much growth in either housing prices or stock values over much of the 2010s. It was a pretty stagnant period. Certainly, we weren't seeing a lot of volatility. It was pretty stable, but it was also really slow growth. And then after the pandemic, we saw sort of a quick comeback. So the stock S&P 500 really grew quickly. And then we saw, also a lot of people investing back in housing and real estate, and a growth also in the house price index. Now, the housing price index, that's the red line, particularly since we started to see these interest rates reach, at least in the last 10 years, a really high level. Housing prices have started to pull back a little bit. So we'll talk a bit more about that. We've also seen a little bit of a pullback in the S&P 500. We'll see where equities, stock values are over the next year or so. Certainly looks to be more volatile. Certainly looks like we're past the peak a little bit, but certainly not something that I think anybody is calling a bear market at this point, or anything that looks too much like a recession either. So let's look a little bit now at Wisconsin's house prices. So just like the national trends, Wisconsin house prices were pretty flat and then grew coming out of the gray bars here is the recession related to the pandemic, and then some growth in house prices, so up to over 7% as a percentage change in the house prices in the state of Wisconsin. And then as these interest rates start to take bite, house price starts to decline. So this is based on sales. So you may be sitting in a home where your assessment has increased. Assessments tend to trail sales. So what you're feeling is that spike right now from the increase in sales over the last year. I think it's important to recognize the fact that housing is a big part of people's wealth. And what's most important is how long you are in your home. So for this is for the Milwaukee, Waukesha metropolitan statistical area based on data from the National Association of Realtors. So just looking at how much people have gained in home equity based on changes in value, depending on how long they've had their house. So 5 years means they've had their house for 5 years, 10 years, they've had 10 years, et cetera. So all the way up to 30 years, somebody's been sitting in their house for 30 years. And these are obviously inflation plays a role here. So these are not inflation adjusted, but somebody who's been sitting in the same house, in this Milwaukee MSA area has gained about $300,000 in wealth from their home equity. So a pretty substantial amount. The 10 and 15-year numbers are stark, right? So the people who've had their house for 10 years have actually been better off than the people 15. And that's because the people who had their house for 15 were exposed to that 2008 decline. So really the timing matters a lot with these real estate values. But even those for the very far left now is the 5-year, about $100,000 gain in value. So the last 5 years have been pretty good in terms of house price gains for many people in the state. So it's been an important source of changes in wealth across the state. I can do the same kind of thing, same data source from the realtors. For Madison, the Madison MSA, a little bit larger, but that same kind of pattern. 5 years, pretty good. 10 years, a little bit better. 15 years, not actually much better at all. And then 30 years, really good. So the time period in which people are exposed to these home equity gains really is important. And this is important too, because many people don't have access to the same kinds of retirement and pension benefits. And so home equity becomes for many a key driver of their net wealth as they approach retirement. Last thing I'll say about the sort of state of where consumers are today, until we can move into some of the more policy issues, is just that people are pretty nervous. So obviously people got nervous about their financial condition and the fact that they might be worse off next year as the pandemic hit. And, I think anybody in March, April of 2020 should have been thinking like, oh man, this next year might be rough. And people certainly did that. So we saw that red arrow shows you in 2020, the sort of rise in the rate to the extent that 1 in 3 people said that they were concerned that they might be somewhat or much worse off financially in the next year. Then as the sort of pandemic reality settled in, things sort of went back down closer to average levels, but certainly still elevated from what we would expected. And then by particularly April, May of last year, about a year ago in 2022, it's close to half. So this is 45% of people thought that they'd be worse off financially next year. So what was this? This was interest rates rising. It was the real bite of inflation, gas prices, house prices, sort of core inflation, food, like all these sort of activities that people were feeling like they just couldn't keep up. As a result, it's gone down a little bit, but still certainly elevated. So I would take from this that consumers are pretty nervous, and that's probably very rational. We just don't know what's ahead. We don't know if jobs are at risk. We don't know if asset values are at risk. So people definitely seem quite nervous about the state of the economy and their own personal situation going forward. So the question I get the most is are we in a recession? I don't know. I don't think so. But I mean, based on the unemployment data being so low, we're certainly not at a jobs-driven recession point yet. There are certainly signals that maybe jobs are starting to pull back, but nothing so far that looks like we're in a recession. So I don't know that we're out of the woods, but we certainly are not currently in a place where things are looking like a recession. It is true housing markets are pulling back. A lot of the house sales that are happening right now are people buying in cash or at the sort of moderate or high end of the market. We're not seeing a lot of the low income or low value, lower some entry level activity right now. So it's going to be important to watch the housing market and see how that plays out. And if that starts to have some impact then on jobs, as there's less demand for home building and home repair and those kinds of services. I think a big wild card here is the sort of quote unquote global shocks, whether that's the national defense risks or a risk that we might see if currencies in other countries, other health risks, political instability, whatever it might be. Those are always things that can create ripple effects to the economy. And I think in general, we're just, people are nervous about volatility. There's a reason why people are really gravitating towards these low risk investments right now, because they're just not sure where things are at. And that volatility is important. I mean, it's not like, something we can just dismiss as being not real. People feel it and they behave accordingly. And so I think that volatility, it's important to recognize that volatility makes us nervous, and then also to make sure that we're making the decisions that we feel comfortable with, given all that volatility. All right, let me talk a little bit about 2 other issues. First, I want to talk about health and wealth and how that equates to Medicare especially, but also just generally thinking about planning for retirement. And then finally, a little bit about Social Security, and then I'm happy to take some questions. All right, so I think one of the key graphs I often show people that probably isn't surprising to you, but often it's surprising, especially as I talk to students or younger audiences, is that people are living longer and longer. In 1940, if you made it to age 65, you were sort of the median. Not that many people made it to age 65. It was 50-50. Today, about 75% of people make it to age 65. So it's much more common today. Life expectancy took a little bit of a dip with the COVID pandemic, but both for men and women, we're seeing life expectancies rising over time, so that, typically, a woman who's aged 65 today is going to live close to 20 more years. And so, that really changes the way we think about planning for retirement and think about the assets that we need as we get into retirement, but also changes the sort of nature of our society and the demands and needs of this aging population and what the particularly healthcare costs are going to be going forward. It is important to recognize that there's nothing magical about age 65. There are lots of people who are, quote unquote, in the labor force, meaning they're working at some level, even at older and older ages, and we're seeing that. Obviously, at ages 50 to 59, there's a really high rate of people being in the labor force. But even at age 75 and older, it's as many as 1 in 10 people are still in the labor force at some level. So, and we're seeing that trend accelerate over time. More and more people are continuing to work at older and older ages, and that's generally great. It's good for people's cognitive abilities. It's great for their health. Oftentimes they're quite productive. If that's something that they enjoy doing, it's great. But it's not universal, and so certainly we are seeing potentially an increase in inequality by income, also by race, by wealth, by other kinds of things. The ability to work at older and older ages oftentimes is among people who make more money. It's because they are in jobs that they can do without needing to require a lot of physical exertion. So if you're in a very manual service type industry, working at older ages may not be as practical. If you're in a more desk-based, more white-collar job, it might be much more likely that you can work at older ages. And so, one thing to keep an eye on as we look forward in society is that we may have more and more, wealth inequality or income inequality, even at older ages, because of people's occupation, because of the types of jobs and the work that they can do may not be so different. So all this longevity has really important policy implications. Oftentimes demography is destiny is kind of the word that we think about. So for many people thinking about retirement, statutorily, you can't claim, so you can claim Social Security at age 62, but you get more. Each generation, their full retirement age is getting a little bit older. So retirement later is sort of built into the process right now. But also more and more people are working even as they reach into those retirement age. So maybe they retire from their primary job that they did for most of their career, but they continue to work as a consultant, or they continue to work part-time, or they take on some totally new job, but they work in different ways. And so retirement increasingly doesn't mean retirement for work. It means sort of a difference in how people engage in the workforce. But the other important thing is that as longevity increases, they need wealth to last longer. So this is a big thing we talk a lot about with financial planners is, planning for wealth through age 80 isn't sufficient. We really have to think about planning through wealth, through age 90 or even older. And then there's a big issue about inequality that we need to think about, and how people who don't have access to that same level of wealth, whether it's housing wealth or savings, and how that plays out at older ages. I will talk in a minute about Social Security, which certainly helps reduce that inequality, but that's important. But the last thing is, and this goes for everybody, is that the longer we live, the more exposure we have to health risks. Every additional year that you're alive means an additional year that you potentially could have either a chronic illness or an acute illness that creates a health issue that requires health care and therefore costs. So we can see this in the aggregate data, sort of for total health spending, for Medicare, which is the light blue line, for Medicaid, which is the yellow line. So over time, aging plus increasing costs of care, meaning we're spending more and more of our collective wealth on healthcare spending. So much so that, some projections are that'll be up to 6% of total GDP spent on healthcare. And that's largely a function of aging society, but also the increased cost of care as well. For individuals, this really means that they have to be prepared for healthcare costs. And so even with health insurance, there's significant out-of-pocket costs. These are deductibles. It's cost sharing and other kinds of forms, or co-payments that people face. So the median out-of-pocket spending, and this is data from 2016. There's certainly, I think, probably some more data that recently that show this trend is the same, if not higher. So for people overall, it's about 12% of their income that they have to spend on out-of-pocket spending. For people 85 plus, it's about 16% of their income. So this is a big chunk of consumption. It's going to be pushing the levels of food for many older people. The amount that they have to spend on these out-of-pocket costs, even if they have insurance. So, most people 85 plus are going to have Medicare, but they're still going to have these out-of-pocket costs. And so it's a big part of retirement planning. We really have to make sure that people have that, liquid cash available should they need it. This is, also an issue for thinking about retirement security overall, is that about half of people 65 and older will need some kind of long-term care. That doesn't necessarily mean nursing homes. It might mean in-home care at some level. But that combined with the fact that many of these care costs are not covered, it's more and more out-of-pocket costs. Plus, it's oftentimes not just one person. It's, a spouse taking care of a spouse or family member, or other family members taking care of an individual older person. So these costs tend to really kind of reverberate as people think about their financial plans and their financial security in older ages. And so you can think about the sort of multi-generational impacts of this, where you have, an older person who needs care, and maybe an adult child is providing some of that care, or maybe it's a middle-aged person who's both caring for older parents and their younger children who are now adults and have children themselves. So we've heard these terms like sandwich generation and whatnot, but I think the truth is that the impacts of healthcare costs, of caregiving, really reverberate within a family broadly. It's not just retained in one household. About 1 in 5 people 65 and older live with a multi-generational household, meaning that there are 2 or more generations. So maybe it's a parent and grandparent, or a child and grandparent. So we'd see lots of increases in these trends over time. And this often is very gendered, meaning that it's more likely women outlive their husbands. So it's oftentimes women who are older, who are in these multi-generational households, or even playing a role as a caregiver for their adult child or grandchild. So we really see multi-generational impacts of these arrangements over time. And we're going to see more and more of this as society ages. All right, so back to some of the policy issues here, thinking about Medicare. You probably saw the news, I guess about a month ago, when the actuaries' reports came out that the Medicare trust fund will be depleted in 2031. I think the headline at the time was that that's a victory, because it used to be like 2030, so it's a little bit better than it used to be. Eventually, though, there won't be enough money coming in from FICA taxes, particularly from the payroll tax, to cover the costs of the insurance trust fund. And so at that point, there'll be a gap. The fund will only be able to pay about 89 cents on the dollar. The assumption is that Congress will fill that with appropriations. I think that's a open question. Whether that happens in 2031 or not, I don't know. It will eventually happen, because Medicare is growing. It's going to be as much as 6% of GDP by 2040. So eventually, without some kind of curbing of costs, we're going to have to either put more money into the system or figure out some other solution. And so far we've seen politicians kicking the can down the road, but this is something that we're facing. And so clearly costs are rising. Clearly the number of people who are exposed to the risks, the number of people covered under Medicare is rising, and it's going to be an important policy issue to think about. There are certainly some solutions, and we've seen many of them being implemented in recent years. Cost sharing is a big one. More and more out-of-pocket costs, increasing premiums, controversial as that may be. The increasing use of cost control programs like accountable care organizations, ACOs, Medicare Advantage. Ultimately, though, we might have to bring in more money, and that means raising the payroll tax or expanding who has to pay that payroll tax. So it's a little bit like the solutions we see on the Social Security side, so I'll talk about in just a minute. eventually we have to do something, right? So either we're going to cut care, we're going to do more cost sharing, meaning more people are paying out of pocket, or we're going to have to find some more revenue or some combination of those things. All right, let me last talk about Social Security, and then happy to talk about your questions. So so again, our center is a Social Security research center, so we do a lot of research related to some of these major programs like the Old Age and Survivors Program, the quote unquote retirement program, as well as disability and supplemental security income, or SSI. So it's a lot of people. About 50 million people are on the Old Age or the Survivors Program, about 10 million on the disability program, and then about 5 million on the SSI program, which is a means-tested program for very low-income older people, as well as very low-income people with disabilities. And then meanwhile, there's about 44 million people who are in the Medicare program. So a lot of people are touched by this. I often say our research really is everything from birth to grave. So low birth weight babies are oftentimes covered under SSI. Obviously, as we get to survivors, it really is through, for families who are have the loss of a wage earner, that survivors program is really important. And then everything in between. So whether it's the onset of a disability or people with a chronic disability, and various programs that they may be involved in. The program has obviously a long history, going back to the FDR administration and sort of the reforms that were put in that place at that time. Really was designed to be a social insurance. It really is an insurance program. It's an insurance against outliving your savings. The idea was that it's an insurance that if you're not able to work because you're too old, because you're disabled, or if you die, then Social Security is available to insure people collectively as a society. So it's quote unquote social insurance. So we're paying insurance premiums to get covered by this insurance. I think oftentimes in the media, it's portrayed as being a benefit, but it truly is designed to be an insurance so that you're paying in based on your relative earnings, and then get a return. If you survive and you're able to claim, then you can make a claim and get a payment later in life. So these social insurance programs are really designed to be, where people pay in, and then if they're eligible and they make a claim, then they can get a payment back out. The problem is that we haven't been bringing in enough to keep the insurance pool, viable going forward. So those are some of the things we have to start to think about in terms of the policy debate. It's really important to remember that what we get from Social Security or from social insurance generally, I would include Medicare in this too, is well-being. It's not a tremendous amount of money, as you well know. It's not enough that people are going to be living very well, but it is enough to give them a sense of control, stability, resilience. It's enough to sort of meet the basic needs. It allows them to make some choices. It allows them to have some, ability to enjoy life. And there's a lot of research actually in quote unquote financial well-being. What it is, regardless of income or wealth, makes people feel like they have a sense of independence, control, stability, resilience. And programs like Social Security are really important for that, as are pensions, honestly. So the idea that you're going to have a regular income coming in makes people also feel this level of control and resilience. And we can see this in the data when we do studies of people's self-reported financial well-being, questions about their ability to control their finances, their ability to absorb a financial shock, their ability to stick to their financial goals. We can see this, and we see it across men and women. We see it across people with an education in college and those without. That when they get to their 60s, especially around 62, their financial well-being goes up quite a bit. And part of that is because they have that regular predicted, monthly income from being part of Social Security. So it really does help improve people's financial well-being. And as a society, it makes, I would argue, most of us better off because of that. Because across generations, we have some sense that we have some control and we have the ability to sort of keep up with our financial goals. There is a strong degree of progressivity in the Social Security program. So these red rows here, the third is the third lowest income level, and then 8 is the third from the highest income level. So it's the sort of third decile versus the eighth decile. So roughly you're talking about $15,000 to $20,000 in income in the third decile and about $55,000 to $75,000 in income in the eighth decile. And you can see as you go across, earnings are much more common among people age 65 and older. About 1 in 5 people in that higher income group are getting some earnings. But only about 30%, 32% of their income is coming from OESI, the old age and survivors insurance. If you look at the lower income group, it's 77% of their income is coming from Social Security. So again, it's this very progressive component of Social Security that is supporting people at, oftentimes whose entire lives had lower incomes to have a greater sense of, financial stability or financial well-being. Retirement plan use is quite low among that group as relative to the higher income group. And you can see the benefit amount is quite low as well. It's only $14,638. Again, it's based on their earnings during their lifetime and how many years they worked. So they're not necessarily getting more money, but they have a greater sense of stability because of that and a greater reliance on the program. So this plays out, I showed you the last slide was talking about income. This is about race. But the share of people who are 65 and older, where they get either 50% of their income, which is the light blue, or 90% of their income, so almost all of their income from Social Security, and that dark blue. And you can see that for general Black and Hispanic households, it's a much higher rate. So these Social Security programs are really important if we're thinking about income inequality, but also for racial equality, inequality, reducing racial inequality as we look at people at older ages. So this is the 2023 annual report from the Office of the Actuary and the trustees at the Social Security Administration. They give a report on both the Medicare fund and also the old age and survivors insurance pool. And no matter what they say, the press comes out with a headline that's like this, like, who's ready for a 25% cut to their Social Security benefits? We've heard this for years, right? So every year the actuaries come out with the report, and every year we talk about how soon it's going to be and how much of a cut people are going to take to their benefits. So it's important to remember how the trust fund works. So the trust fund is collecting FICA taxes, payroll taxes from every payroll all the time, putting that into the fund. And then Social Security Administration is paying out benefits plus a tiny bit for their administration. And then if there's not enough money left, then they have to start spending down the fund. So that's sort of the idea of spending down the fund. So that orange area in each of these graphs is the amount that they're spending down the fund. You can see for most of the last 10, 12 years, they've been not spending down. The net amount of the fund has actually added more to the fund, but in the last, especially 2 years, they've been spending down the fund. And the same was true a little bit of the last few years. So we're getting to the point where the fund is starting to not have a net addition, but we're actually taking money out to make these benefits. And that's the problem, is over time, these net outflows are going to start to bleed down the amount of the fund, and then the fund won't be able to make the same level of payments. We don't hear a lot of politicians talking about this, but there are some real ways we can address this. This website, the crfb.org, has this tool, a calculator called the Social Security Reformer. You can test, like, what happens if we raise the interest rate? Or no, sorry, what happens if we raise the retirement age? What happens if we change the amount of income that's taxed? What if we limit benefits? What are the different things so it gives you, I don't know, probably 24 different options that you can experiment with. And you can see how much of the gap in the trust fund can be closed. And it turns out, like, some simple things like raising the retirement age to age 69, which is not a huge gap for people who are currently in their 30s. It's basically raising it by about a year. That would close 41% of the gap. If we were to look at the raising the taxable income that's subject to the Social Security tax, so there's for a single person, we see, there's a point at which their income is no longer taxed at a certain income level. What if we raise that up so that you paid more of your earned income? So more of your earned income was subject to the payroll tax. How much of the gap would that close? So you can also talk about, instead of looking at the 35 highest years of work, looking at the 38 highest years of work. So there's lots of different options you can look at. there are real ways to solve this problem. Now, the problem is that we're not seeing politicians really explore them because, obviously there's winners and losers in all these debates, but there are some really practical things that could be done that would make Social Security much more viable going forward. I'll start to wrap this up and we can get to some questions, but this is as obviously a financial issue, right? So we do care about the fact that people might be getting, whether it's 70 cents on the dollar or 80 cents on the dollar, it depends sort of how things play out, but they'll be getting less per month if we don't do something. But it's a bigger than just the financial issue. It's also a real important policy issue. It affects people's well-being. It's especially important if we want to think about inequities by race, by income, and people who have more and more financial insecurity are more likely to become more and more reliant on other people in their other generations, other people in their household, other people in their social network, other people in their familiar network. And so this really affects lots of different parts of society. It's not just old people versus young people. It really is a collective problem. Oftentimes, unfortunately, what we see are advocates or politicians who make this as a pitting the young versus the old, and it's just not helpful. We have to sort of recognize this as a collective problem. I will say I'm heartened by what happened with the Secure 2.0, which was a law that maybe didn't really pay attention to or see because it happened during the holiday break. But Congress, in a bipartisan way, passed a law to try to make some of, especially employer-based retirement plans, work better. It was about 200 little technical fixes. It was nothing that probably got a lot of press. The thing you may have paid attention to was they raised a little bit the requirement and distribution for retirement accounts for 401k and other independent retirement accounts. But what I take away from this is that this was a positive political event. It was bipartisan. Industry worked collectively and they got some stuff done. So maybe there's hope that we can start to see some progress on things like Social Security. Hopefully not at the 11th hour. Last thing I want to say, there's been a huge rise in fraud and scam for both people who are currently receiving Social Security benefits as well as people who are eligible for them. We've done a couple of studies at our center on the spam emails and the calls that are out there. Not saying this applies to you, but if you in your network of friends and family ever hear anybody who's ever been perhaps subject to something that seems fishy, call the Office of the Inspector General at SSA, submit a report online. We're trying to better understand the issues that people are facing, but there really does seem to be, especially since the pandemic, an explosion of these frauds and scams. And so it's a project we've been involved in to try to help people to avoid these scams, but also to just get better information about the extent of to which they're happening out there. You can find more about our center, the Center for Financial Security and the Retirement and Disability Research Consortium here at this website. We do about a dozen or 15 projects a year on topics related to retirement and Social Security research. We also have some webinars, podcasts, things that are perhaps a little more interesting to read than some of these academic style papers. There's a lot of briefs and other kinds of interactive tools on the website as well. So you're all welcome to find more about that. So with that, I'll stop sharing and I'm happy to take any questions that folks have.
Thank you, Michael. We have a few questions for you. What happens if debt ceiling negotiations fail and the U.S. can't pay its debts? That's a big one.
That's a big one. It's never happened, so we don't know what's going to happen. We've heard all kinds of crazy solutions, including what the $1 trillion coin, I think, is one of them. I'd like to think this isn't something we're going to find out to see what's going to happen. Were the U.S. to really default on its obligations, it would have impacts not just on the U.S., it would have impacts on many countries because they use our securities as their investments. So they're not sitting on cash, they're sitting oftentimes on U.S. government securities. So it would be a really huge problem. A related issue to this is what happens to security payments. And that's something that's been discussed as well, as whether there might be a carve out so at least they can make Social Security payments and debt payments, but maybe not other kinds of payments. So it's at this point, it appears that it's just going to be, when does the ceiling get hit? And at that point, whatever, it doesn't matter if the next payment is a Social Security payment or a foreign debt payment or whatever, it will just stop. And so I really hope we don't get to this, because it would be a mess. And so I'm hopeful that there is some solution that comes into place before we have to test this.
Next would be, what's been the rationale for income limits on payroll Social Security deductions? Should this be altered or abolished? You answered that in part, but
yeah, obviously there is a limit in that there are some people that make millions and millions of dollars in income, and by the nature of the Social Security, quote unquote benefit payout, they would be paying way more in than they'd ever be receiving. So I think that's why there is a limit of some kind. Why the limit is relatively low, and I'm saying relatively low because, for example, if we look at for the IRS income tax levels, they don't really kick into the highest levels of marginal income tax rate until about $500,000 for a married couple, or so we have a much lower, I think it's about 140,000 for the payroll tax. So it does seem like we have some inconsistencies in terms of how we treat what's considered high income for Social Security versus what's considered high income under IRS tax regulations. So certainly raising the amount that's subject to the payroll tax would go a long way to reducing the potential gap that exists between the trust fund and projected payments.
okay. Next is what's been the rationale for income limits on payroll Social Security deductions? Should this be altered or abolished? I think that's, I may have done that one when I forgot to do my job.
I think it's the same answer.
Yeah.
If not, yeah.
In part, is part of the problem with Social Security its complexity? Are changes possible?
That's a really good question. I always think about the system. It is what it is, right? So why does it exist the way it is? It is complex, but it's also kind of simple. I mean, it's a social insurance. You pay in, and there's a payment out. The complexity comes in terms of what counts for making a claim. Sort of, what are the age at which you can make a claim, and then also what are the what's the sort of earning period that counts, sort of with number of years and those kinds of things. So that complexity has kind of evolved over time because people's situations are so different. A simpler system perhaps would be easier to make some arguments about a fix, so to speak, but potentially it might not meet the needs of some people who who would benefit a lot from however the rules evolve. So I think that's part of the thing, as we've evolved with 70 years of different rules that have been put into place, and those are generally designed to try to help improve the well-being of the most people as possible, but it also creates some of the complexity. So part of it, I think, is on us as academics or on policymakers and others to try to explain it in a way that isn't so complicated and not get bogged down in the details, and really talk about the idea of this is a social insurance, and we're talking about bringing in sort of more people to that pool, or more money to that pool, so that we can better meet the benefit demands going forward.
Okay, and then kind of along the same lines, why don't we talk about taxing the extremely rich at the same level that we are taxed?
Yeah, I mean, that's probably a political science question, but I would agree. Yeah, we probably ought to have more consistency in how we treat different kinds of taxes across different levels of income.
Okay. Next is, in your chart of increasing retirement age to 69, showing a 41% close in the gap, does that assume a gradual transition or an abrupt change to retirement age?
Actually, I can't remember because it's been a while since I played with a calculator. I think it assumes an abrupt change, but only subject to, so I think it wouldn't count for people under 50. So it would be only people who are under 50 would be subject to it, or, something around that. So it's abrupt in that those people, it wouldn't be like, gradually phased in for each age group, but it would happen to everybody who's, 50 and younger or something like that.
Okay. Next one is what significant policy change at either the Wisconsin or national level do you think is possible politically that would decrease inequality and improve financial security? That's a pretty big one.
It is. It's I wish I knew the answer to that question. I wish that I had a politician that I could put forward to say that really was caring about this too. In terms of inequality, programs like Social Security or even our own pensions are really important because at older ages they sort of can help people who, particularly if you think about lower wage workers who most of their working years worked either independently, didn't have access to a retirement plan, or worked for a smaller business that didn't, they just weren't big enough to have a retirement plan. We're lucky to work for institutions that have retirement plans and be able to benefit from that. And so it's even more important for programs like Social Security to kick in those places. But just more generally, if we think about state policies that can improve inequality, a lot of it comes down to education. And I don't mean to sound like I'm, stumping on behalf of the UW, but it is education oftentimes that is an equalizer in people's earnings. And so it's greater access to, high quality primary and secondary education, but also community colleges, technical colleges, and, competitive higher education as well. So the state has not been a super generous state for, many educational policies. And so, finding more ways to include more people in the educational system in the long run is a way to address some of those inequality issues.
All right, one more. Has there been any attempt to quantify how insurance companies and private equity having veto power over medical decisions encourages medical professionals to leave their jobs?
Yeah, this is not my area of research, but I do have colleagues who do health economists who work in this area and really think holistically about how the interactions of the healthcare provision system and the companies that employ healthcare providers, and then the decisions of people who decide to go into healthcare and how they all interact. And I think a lot of the research is not very optimistic, at least in my interpretation, that we're designing systems that incentivize really talented people to go into the highest return specialty fields and not as much into some of the more important and, honestly, the fields that we deal with more often, the sort of primary care, family care, that kind of thing. And then as you get larger and larger healthcare organizations, it makes it more and more difficult for these, really skilled practitioners to be able to maintain their careers. And so we see more and more people leaving early, more people changing, people who've invested a lot in their higher education, leaving the field or not entering the field at all. So I do think those are some of the important issues that we have to think about going forward. And, really tough to think about how you regulate some of those kinds of things too. So great question. And I think, healthcare policy is a really important one. We've got a lot of students at UW who are pursuing this as a topic. I think it's because they recognize that this is a big issue we're going to have to with aging people, aging populations, and increasing healthcare costs. Frankly, better and better healthcare technology too. We've got to sort of be on the cutting edge of trying to figure out the best solutions to make this system work for everybody.
And I have one last question is what effect on inflation costs might have been caused by not raising the minimum living wage for a few decades?
Yeah, that's a tough one. So the minimum wage is kind of a signal, I think, to employers, even if they don't pay the minimum wage. If the minimum wage goes up, then they might try to pay a little bit more. Wages were so flat for so long in the 2010s coming out of the Great Recession. I think it would have been hard politically to increase the minimum wage, but had wages cut off a little bit, we wouldn't have this. I think right now is we're seeing this pendulum, right, where workers were relatively underpaid, even though they probably were productive and probably should have been paid more. Then employers said, "Hey, we really need you. You are productive. We need you. We're going to pay you more to keep you here." And so now the pendulum is at the point where workers are demanding more and more, and there's sort of a shortage of workers in some industries. So yeah, it's true. I mean, I think the hard thing with the minimum wage laws is that they're just very, very political, very, very hard to implement. And so as a result, they're so low that they are more a signal than they are actually any kind of binding limit on how low wages can go. Since most employers tend to pay something above that, they just kind of use it as a marker of what the relative amount of wages ought to be.
I have one last question. Has part of Social Security been with its investments?
You should think about the investment pool for Social Security as our collective GDP, because it really is. The trust fund is betting on the future of our earning potential. It's this sort of idea of a trust fund that's invested in some, much like SWIB might do. That's not really the way it runs. It really is designed to be, the rate of return of the economy, and that it's not like it's invested in any particular pool. So the more productive and efficient we can be as an economy, the better the Social Security trust fund performs overall. But it's really not the same kind of a pension fund style that we might see in other kinds of retirement vehicles.
Okay, and that is the last question I have, so I will turn it back. Thank you again. Back over to Diane.
Michael, thank you so very much for your information. A lot of similarities between all three of them for retirees like us in the pension and the effect on it to having a very secure retirement. So thank you for all of that wonderful, wonderful information. And with that, I want to thank everyone who is attending this virtual Wisconsin Coalition of Annuitants conference today. We hope that you will be able to join us next Thursday, May 18th, for the second part of the conference, again, starting at 9:30. Please take a moment at the end of this session to complete the survey. When you press the red leave button, you will be directed to the survey. Completing the survey is going to help us in planning future informational meetings. And again, thank you for attending and have a wonderful day.